The show right now. Ed, hi, great to have you on ET Now today. Ed, just wondering, considering the CPI number has slowed more than expected and the fact that it's the smallest 12-month increase that we've seen since May 2021, do you think that makes the case stronger for a pause in the next policy?
I think it makes a very good case for a pause, but what's especially important is the banking crisis. Even the minutes showed that there was a concern among the staff, the economists that work for the FOMC changed their forecast, and they're actually talking about a mild recession in the second half of the year. So I think the Fed has managed to get the Fed funds rate to a restrictive level and doesn't have to go any further.
This imply now, this time around, with the core CPI jumping about 0.4% Ed on a month-on-month basis, is there now going to be a lot more pressure on the US Fed?
Well, I think the pressure really comes from the data. The Fed always says they're data dependent. And what's pretty clear is that the economy is doing relatively well, but slowing. But what's even clearer is that the rise in interest rates has put a tremendous pressure on banks because we're experiencing what's called disintermediation. In other words, money is coming out of the bank deposits and is going into the money market funds where interest rates are higher. So the worst thing you could possibly do in a banking crisis is continue to raise interest rates, making disintermediation even more of a problem for the banks. So I think they've got to cease and desist and leave the Fed funds rate right here around 5%. And I have no problems with them leaving it here, but I think it would be a mistake to keep raising rates.
Ed, I'm also looking at, the March Fed minutes, wherein, while on one hand they're saying that all officials did back a 25 bips hike, but I think it's more the future projection that they're talking about, the fact that they actually see a mild recession starting later in 2023. You think it's inevitable because, the talk around recession has lasted for a while now?
Yeah, well, if we have a recession, it'll certainly be the most widely anticipated recession of all times. It'll go down in the history books because usually recessions aren't that widely anticipated. And so it's possible we'll talk ourselves into a recession. If we're all going to say we're going to be in a recession, we're all maybe going to change our behavior that does that. On the other hand, it probably means that people are being more cautious, being more careful, and maybe that we won't have much of a recession. I don't even think we're going to have a mild one. I think we've been in a recession since the beginning of last year. It's just been a rolling recession, hitting different industries at different times without adding up to an economy-wide downturn.
What is it that you're penciling in terms of the trajectory now down the line from the US Fed going? And do you believe that we are likely to see a cool off in the inflation numbers?
Well, I think that that inflation will continue to moderate. What we're, I think, discovering is that inflation in the goods sector was, in fact, transitory. It lasted basically a year. It peaked at the middle of last year, and it's down quite sharply so far this year. I think it'll continue to remain low. And then, of course, later this year, we're likely to see some improvement in the services area, particularly in the rents area. So I think that inflation is going to cool off without having a recession.
Okay. Good to have you on the show, Ed. Thank you so much for taking the time out and speaking with us today. Well, not just the US CPI.